Peter Rose, Longwood Currency Trading. Understanding how to use the win-to-loss ratio in your risk management is the topic I'd like to chat a little bit with you. I've had some conversations with some folks, again, through email, that I try to help, no charge or whatever, because a lot of times I can get folks on track. And this one particular discussion revolved around the win-to-loss ratio. Well, why is that so important? All it's going to tell me is that on average I win so many times as opposed to the times I lose. I'm a 60-40 trader. I win 6 times out of 10. I lose 4 times out of 10. So what? Well, it's more than so what. It has to do with risk management. And before I get into risk management, a little tour here. This is our new bones of our new deck that we just got put on. Been working on getting that structured. It's a little late in the year. We're in early November right now, and it's going to get pretty cold up here in New Hampshire, up in the Lakes region where we're at. We're up on a little mountain, and so our temperatures tend to be 10 degrees colder than it is 2 miles down the road. So we're getting down in the mid 30 degree Fahrenheit range in the evenings, but it's up in the 60s during the day, so low 60s. So we've got time to finish off the deck. Not really much more we want to do. We're going to keep the sides open, and that's managing a project is something that you need. What do you need when you're trading currencies? Well, you need to make money. And what's the tool that you use most in order to make money? It's risk management. Now, there's a lot of different rules and tools that you can use in order to incorporate that, but I think one of the most important, or the most important, is how you apply your win-to-loss ratio. I may get stuck here and have to cut this off because I've got a beeper in my pocket, because I have to put the lasagna in the oven tonight. Win-to-loss ratio, you're a 60-40 trader. If you can limit your loss to 10 pips, in other words, a static hard stop loss, there's other times that you can lose. I mean, once you get into a running position and you start messing around with that, you can still lose money. If you're staging lots and you do it the wrong way, again, I was talking about this just the other day on a video where I'm doing a computer simulation analysis on the relationship between the average position value and the current price, and if that current price swings around and drops against you and it takes out the last added lots to the position, even if the average value is above where the lot before that, you still stand a danger of going into negative territory. It's a really delicate balance. But in any event, you can still lose money there. So you have risk management issues beyond the opening stage that I'm talking about here. So here's the deal. You limit your loss to, let's say, 10 pips, 8 to 10 pips. Let's call it 10 because it makes the calculations easy. And when you win, in conjunction with the win-to-loss ratio, you have to understand what your average win value is. And the average win value is supported as a function and a relationship with your per trade expectation value. I'm not going to get into that aspect of the math of it, but simply to say that you better be, because you can have a 90%, nine winners and 1 loser, and you could still lose, right? I mean, if you win $100 each time that you win $900, and if you lose $1,000 on that last one, you're $100 down. So you could still lose, even with a really good win-to-loss ratio. That's why the average win value is important in all these calculations. So what you're saying is that, look, I'm a 60-40 trader, and you shouldn't be a 60-40 trader for long if you really understand your mechanics of how you do the currency markets. edge or the win to loss ratio in currency is a little bit different than it is if you're doing stocks or commodities. There's some reasons for that, but it is a little bit different, and so you have to take that into consideration. But when you're setting up your currency trades and you're looking at your win to loss 60-40, okay, I got 10 pips, I'm trading one lot, it's $10 a pip, I'm going to lose $100 4 times, I'm going to lose $400. How do I make that up? I've got 6 more times to make the $400 up. So if I win $100 6 times, I'm going to be $200 up, right? So there's your combination of your win to loss ratio and your average win value. I can say I'm averaging 10 pips when I win. So you're basically breaking. When your risk and your reward is not risk reward, but the amount of money that you are balanced with that. It's a 1-to-1, and anything you have over your loss value is going to be a profit. So the next question you ask yourself in entry analysis is the $200 that I'm going to make risking, well, you're risking $10,000, right? Or just to keep it easy to trade one full lot. So it's 200 divided by 10,000 is 0.2%. Did you really gain anything? And that's 0.2% over 10 trades. So you divide 0.2% by 10 trades, you get 0.02%. So are you really accomplishing what you need to accomplish as a winning trader? Well, you're not. So that's one issue of the win-to-loss ratio in risk management. The second issue has to do, my alarm is about to go off. Back to you in a sec. All right, let's get this lasagna in here. That's that. Okay, good. Oh, nice. Let's make a mess. Yep, we're going over to my son's tonight and see our little new baby granddaughter. And that's the reason that I had lasagna detail. And now we need to continue with a little bit about win to loss. So that first part about the win to loss ratio is how you use it. You know, what's the purpose of having a win to loss ratio? The risk management part of the utilization of the win to loss ratio comes about a little bit differently. You're looking at a position and it's moving in your favor, but it's gyrating around a lot. This is generally used in high volatility situations where you don't put a stop. I don't put a stop. You better put a stop, but I don't. And I get caught. Yep, I get caught, and I lose a lot of money. Then you have to back up, and you have to back into the position in a little bit different way. And when you do that in a high volatility situation, and you don't have a stop, then you're exposing yourself to unlimited risk, right? So you have to say, oh man, how much risk do I want to take? Do I want to, if I'm normally losing $100 on that $10,000 account with my 10 pip stop, am I willing to lose 1,000? And this is where that win to loss ratio and your average win value come into play. For example, in the 40-60 situation with an average win of $100, I'm $200 over 2 trades, or 10 trades, which is $20 a trade. And we looked at that and said, geez, $20 divided by 10,000 just isn't worth doing. So you've got to get your average win value to be higher, right? Or you've got to improve your win to loss ratio. You jump back to that situation where we're a 60-40 trader and you would normally lose $400 over the 4 times, and you make, now you're going to make $1,200 over the 6 times, because you're making 20 pips at $10, you're making $200 times the 6, you're making $1,200 minus the 4 that you are losing. You've got an $800 gain over the 10 trades, so that's $80 divided by 10,000. So you're about 0.8%, right? And so now you're okay. That's premised on the fact that your average win value is $20, that you can do that. So I guess what I'm saying is that your ability to judge how much risk you want to take, if you're doing it over the 10 trades, it means that each trade is worth $80 to you, right? So if I'm going to go out there and lose $1,000, if I'm going to say, well, I'm going to let this run until I'm $1,000 risk and then I'll cut it, what your win-to-loss ratio is going to tell you is how long is it going to take you to make that money back. So I've got an over a 10 trade period of time, I can make $800. So I'm going to have to trade about 12 or I'm going to have to do 12 or 15 or so trades, 20 trades maybe, in order to make that up. There's 20 trading days in a month. So by taking a $1,000 risk with a $200 average win value, it's going to take you a month to make that money back. Do you want to do that? If you took a $500 loss, same principle. It's going to take you 10 days about to make that money back. Do you want to spend that much time? If you can make a couple of $100 a day, or $100 a day, $200 a day on your trading, and just to get back into the normal scope of things, it's going to take you 10 days. In other words, you're losing 10 days of trading in order to get back to break even, where you can start actually making money again. And so you have to balance the risk that you're going to take in these volatile situations. If you say, gee, this thing is, the ATR on this 5-minute chart, I'm trading on a 5-minute chart, has gone from 5 pips to 15, and it's just crazy. The spread is 3 pips, 4 pips. So you would get before Friday's close. A lot of the times you'll see the spread go to 14 pips on some of the major pairs, 8 pips. And so when you get in these volatile situations, you just don't know what's going to happen. So you can best guesstimate how much you'd be willing to lose, hoping that the price will turn around such that, in other words, you're letting that price go. So let's say it's $800. I'm willing to lose $800 because I can make that back up in 6 days, and I'm willing to risk the 6 because if that thing turns around, it goes in my favor, I can now start to do some negative staging, add to my position, and instead of that particular position making an average of $200, it could make me $800 or $900. And so you have to balance that projected win. And this is all fly in the sky stuff, right? Because you could just say, oh, well, I think the position will give me $800 or $900 of profit. But you don't know that. And I get stuck many times because I'll end up, because I like to trade in the volatile situations. I like to get in there and mix it up because that's where you can make some money if you know what you're doing. But you can also lose a shithouse full. And so I have to pull the stops off, and I have to be willing to let those things run pretty far. And sometimes the dollar value that I'm underwater is pretty steep, but it isn't as steep as someone who would go all in, all out. I'll stage into these. If I've got 20 lots that I can stage in, you know, I may only open the position with 3 or 4 lots. And so those go against me, and it might be, you know, 50 pips that's against me. I've got 4 lots at 50 pips. You know, I'm $2,000 out. But by having the price go up there, when it turns around and I can start to stage in, all of a sudden those 4 lots staged with another 4, I've got 8 lots now, $80 a pip, and I'm going to take that 20 or 30 pips, $3,200. And I've done that a lot. But if it goes badly for you, you can lose 10 grand just like that, boom, on those larger position sizes, right? And so you have to be very, very careful. I'm not trying to tell you how to trade. I'm trying to tell you what you can use the win-to-loss ratio and your average winning value for in order to calculate how much pain you can afford yourself in some of these situations where you may not have a stop on, or you may be in a winning position and you've made you've done a couple of ads and the price spikes down against you, and you find yourself with 6 or 7 lots, and you're underwater at 6 or 7 lots because the price has come down and taken out the last 2 stage points that you've had of 4 lots, let's say. That's very easy to happen. Very easy to happen. And that's why you have to be a little careful about the staging. Sometimes the reason I'll make a mistake is because I get all wrapped up in the 15 and the 5-minute charts that I'm working on and setting these reversal points, and what I really should be doing is stopping and going out to the 4-hour and saying, where's this thing going to come back to? How far has this thing got to go before it comes back? Well, it's got a long way to go. Well, what are the chances this thing is going to come back 100 pips, and I'm at 50 pips out right now? Maybe I better just cut it, because even if it turns around and comes back, it's got to come back 150 pips in order for me to make my money. What's the likelihood that it's going to come back 150 pips today? And what happens tomorrow, over the weekend? Maybe a non-farm payroll coming up. This thing could go 200 pips against me, and I've had that happen. So I don't advocate how to do this, or that this is a methodology that you'd want to implement in trading. But it is a way for you to limit the amount of money that you're going to risk if you're going to pull that stop and you're going to trade in a volatile market, or you're looking to swing the fence and try to make that long run to the gain point. You have to be willing to give that a breathing room if your volatility is a little stiffer than what it normally would be. You're trading out of bounds of the normal trading process. I don't tell anybody to do this kind of stuff unless I've been working with them for probably about 6 months, or that they have at least 6 months of training and they've seen the different environments and they've got caught a few times and done that. And then I say, okay, well, let's look at the math behind this thing and try to work backwards as to what your acceptable loss limit is for what your win-to-loss ratio is, so that we can unscramble the problem and so it doesn't happen again. Because how many times are you going to lose $10,000 before you go, man, this really sucks? Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.